All right, welcome everybody. This is CyberBulls. So we've got the gang here. We've got a special guest bull with us, Gary Black. He is the managing director of Future Fund. We want to hear more about what he does. We've got Alexandra, Xander's on the road, and we've got Jeff with us. Christian's not available today. So why don't we start with you, Gary? Tell us what you thought about the Tesla production and delivery numbers. And then specifically, I want to know what is happening with the analysts. Like some of them re-rating and some of them are actually raising their estimates kind of blatantly. But tell me what you're thinking.
Well, obviously the numbers are really good. You know, they delivered 466 versus 448, and that's a big beat. And so the stock did go up, and it should have gone up. You know, the analysts raised their second quarter earnings because, again, if you have more volume, you should have more earnings. So the second quarter numbers went up to about 82 cents from about 79. But interestingly, that's earnings. But interestingly, they didn't take their full year estimates up. The full year 2023 estimates went up by less than 1%, and 2024 went up by less than 1%. So they're still not believing. And as you point out, you had a lot of people who said, okay, I'm going to use this opportunity to downgrade the stock because it's run up too much, which I always think is kind of a foolish reason to downgrade a stock. You downgrade a stock because fundamentals are getting worse. But you don't usually see people downgrade stocks because, you know, the price, which was above their price target to begin with, is now even more above their price target. So it's kind of lame. And so when you saw Goldman do it, Morgan Stanley did it, a couple others, it didn't, the stocks didn't really react to that, which it shouldn't, because that's kind of noise. So, you know, we're kind of in a situation where until you see 2023 estimates start going up, 2024 estimates start going up, you're kind of stuck here at about, you know, 270, 280. And I would like to see, you know, when the earnings come out, some indication that management thinks auto gross margins have bottomed, because that's what people are looking for. You know, the street is at 19 in the first quarter was the actual number for auto gross margins ex spread credits. And the street's at about 18.3, 18.4 for second quarter. That should be the bottom. Then it should start moving up. If people could get confident that it's about, meaning no more price cuts are coming, or that if there are going to be price cuts, they'll be matched with cost declines as well, then I think the stock can move up. But otherwise, we're kind of stuck here for a little bit.
Okay, Gary, why don't you explain what you're thinking? So what is your expectations for margins? What's your expectations for, did you raise the earnings for the next year?
No, I'm above the street. I'm at, so for this year I'm at 360. The street's at about 348. For next year I'm at 540. The street's at about 480. And the reason I'm higher is because of CyberTruck. You know, many were here in 2020, 2021. And what happened when Model Y came out, it wasn't just Model Y bringing Tesla into a new category, which was CUVs, you know, cross utility vehicles. It was a halo effect for the whole Tesla franchise. And that's what's going to happen with CyberTruck, probably even more. People are going to see it. They're going to go to the website or they're going to go to the store and say, tell me about Tesla, because that's a really interesting vehicle. And they're not necessarily going to buy a Cybertruck. Only so many people like the design. So many people are looking for a pickup truck, even this one, which is pretty big. But it'll allow them to learn more about Tesla. It's almost like a big walking billboard or driving billboard that will cause people to buy more Teslas. So my numbers for next year are 540, the street's at 480. If you just look at my numbers for Cybertruck next year, I'm at about 200,000, because they're going to start this in the third quarter, in theory, assuming that, you know, all systems are go, start delivering in the third quarter. So by next year, I think they can get to 200,000 of deliveries. Street's at 90. And if you just crunch out what's that worth, that's worth about 60 cents a share. And then I'm adding about 20 cents a share for, you know, all these deals that, you know, they've done with Ford and GM, and everybody's going to sign up to allow their EV users to go to the Tesla supercharger network. So I'm above the street. I might, you know, take my numbers up after earnings. Let's see what they do on gross margins. And most importantly, let's see, you know, what kind of indication they give. One of the things that I just want to make sure everybody's aware of is, in 6 of the last 10 quarters after earnings, the stock price has actually gone down. And that's despite that in 8 of the last 10 quarters, they've actually beat the earnings estimate. Remember, in first quarter, they actually missed by a little bit. So somebody's out there saying that they've beaten 9 consecutive quarters. That is not a true statement. First quarter, they missed by a penny. And, the earnings quality has not been great. There's been a lot of one-time, revenue increases or cost declines that you really should be backing out. Nobody does that. And so I don't think the earnings quality has been great the last, couple quarters. And first quarter was terrible, and that's why the stock went down 10%. So what I'm going to do is wait and see what happens in the quarter. Hopefully they give an indication that this is the trough in auto gross margins ex reg credits. I'm about where the street is, 18.5. Remember, it was 19 in the first quarter, and then I've got it gradually rising to from 18.5 this quarter to 19 next quarter to 20.5 in the fourth quarter, and then I'm back to 21 and change for 2024. So that's what I would like to see, and I know that's what investors would like to see, that auto gross margins.
I have a question. What do you think is the average selling price for the CyberTruck for this year and next year?
So I'm not lazy, but I just keep it simple. I just put it where Model Y is, because Model Y and CyberTruck, when they first announced it, they were about the same price. And I'm assuming CyberTruck's going to start at 49, but it'll go higher. It'll go up to 89 if you order a tri-motor, or I don't know if there's a quad motor, but I know there was a tri-motor because that's what I ordered. And so I think the average selling price is going to be probably a little bit above where Model Y is, and that's what I'm assuming.
Okay, so you don't think that the initial 2, 3, 4 quarters will only be the high-end version, and therefore only the 80?
Yeah, that's a fair point. Usually when Tesla brings out something, they start with tri-motor, the biggest and most expensive first to bring it down. I don't know. I know there's a debate back and forth about, will Cybertruck help auto gross margins or hurt them? Usually when something starts up, there's issues, right? So I think for the first couple of quarters, it'll be a drag on auto gross margins a little bit. But to your point, because they're going to make a fair amount of money on Cybertruck, I think it'll be fine. So I'm just assuming that auto gross margins will move up, because the rest of the franchise is leveraging itself, especially Model Y. Model Y is now 65% of the volume, and Model 3 is another 25. And look, we don't know what's happening with Model 3. We believe there's a new improved Model 3 coming, and hopefully, that will help margins. But initially, when you're first starting up something, there's always issues with the manufacturing process when you start a new version. And I think the same thing will be true with what they're calling it, a Highland Model 3. It'll start in China. But I do think you'll have a little bit of drag on earnings because of Cybertruck being new, and Model 3 will be new. But Model Y will continue to leverage.
A Model Y, there's rumors about a refresh as well. And I just want to get back to you on those 6 earnings that didn't have a positive effect on the stock. Do you think that's more a question of subpar earnings calls rather than numbers? Because I always have the feeling the numbers the market can live with, and then the earnings. And I mean, I've been calling for a couple of, and I know you're not agreeing with me, but for a couple of quarters that Elon should just not assist to these earnings calls to make them as boring as possible and get this whole thing off the ice. But I guess we're having another one where we'll hear from Elon. And so no matter the numbers, it's actually much more about the call, right?
I like Elon on the call. I think you get, fresh perspective. And, Elon by his nature is not conservative on these calls, where Zach is. So I think what happens is Elon makes a bold claim, we can get to even 2 million units this year. And then Zach has to kind of rein him in, and Zach plays the CFO, and Elon is the optimistic CEO. So I actually like Elon being on the calls, because I think you get, pretty transparent view of what he thinks is going to happen. And, Zach plays the controller, the guy who's trying to bring him back in. But I'd rather have Elon on the calls than not on the calls, even though you're right, he tends to say things that are unpredictable.
Why don't we do a roundtable? So we've heard you say your estimates for earnings per share is $5.40 for next year. Yeah. And then so I'd like to hear, did you tell us already what your expectations are for margins on July 19th when they report the Q2? Are you thinking 18%? 20%?
I think 18.5. I think, again, because costs have come down. I mean, you've seen lithium come down. You've seen other raw materials costs come down. The container costs have come down. So I'm going to go out on a limb and, say 18.5, where I was thinking more 18 before. And I do think you'll get a number that's north of where the street is for second quarter. I think the street is now 82, up from 79. So I'm looking for a number that's 85-ish. And so I always try to be conservative. I don't think you get any credit in, pushing the estimate up. So even with the volumes for second quarter, I thought I was going out on a limb by saying 450, but I wound up being pretty high relative to this crowd and relative to most people. I think there was, only a couple people above 450, but I thought it could do 460, and they did 466. So I think for the earnings, it could also wind up being higher. The only thing that gives me caution is they are discounting the inventory, or they did discount the inventory a lot to move all those units at the end of second quarter. So you just don't know what's going to show up in the gross margin number.
All right, why don't we go through a roundtable here? We'll ask Jeff and then Xander and then Alexandra. What do you guys think your estimates are for, I think we did this last week already, which is margins for Q2, and then earnings per share for next year. And then tell me, you guys, what do you think will happen to the stock if it was 18.5% as the auto gross margin? What would happen at that point? So start with you, Jeff.
Yeah, I'm pretty conservative in this quarter on the gross margin side. I put a range of 15 to 18%. I agree with Gary that this will be the trough quarter. I also, though, would like to put it out there that I do believe that there's going to be a favorable surprise on COGS. I don't know if it's going to be this quarter or next. There's a couple things going on from a supply chain perspective. One of them, it's fair to say that we're in a freight recession that spans both container cargo, trucking, and other forms of transportation. And inventories are up in warehouses significantly. So, those costs have come down significantly, and those costs hit pretty quickly. Many of them are contractual, but they've been on the higher side for the last 2 years or so. So I believe those are going to come down fairly rapidly. And there's other commodities that have rolled over. The China return has not been as thunderous as many thought. At some point that they're going to really turn on the stimulus and really at a much higher level. But that the China return hasn't been where it's, so commodities are significantly lower. So Tesla this is what people sometimes don't consider, is that they're, of all the automakers, they're the ones that have the highest growth in the highest growth category. So when they're sitting with their supply base and they're sitting with their partners and they're doing a cost negotiation, they're literally on the leverage side of every one of these conversations. And it's to the point, it's that extreme where it's probably almost every conversation they're in. They can point to their competition, both in EV, outside of EV, and say, partnering with us, doing a long-term relationship with us. Oh, can you help us on Model Y? Maybe we'll give you an award on the bot, which they're definitely doing supplier selection at this point on something like the bot, or supplier selection on the Gen 3 platform, which is happening right now, and there's a food fight. So I believe this supply chain leverage that they've built over this past decade is now culminating, and there's going to be a significant COGS surprise, because they can leverage. They don't even need with their supply base and their long-term roadmap. They can tell suppliers to take a leap with them. And they can say, look, you help us today on Model Y, you help us today on Model 3 Highland, you help us today on this initial CyberTruck order, we'll make it right for you. So they have suppliers fighting for business. So long story short, I think an upside surprise is coming on COGS. I'm not sure if it's this quarter or next. I do believe that they'll be on the better side of 80 cents per share, maybe over 85 cents per share this quarter. I'm going to study that a little bit more closely. I do think, though, with my take on COGS, I do think that they're going to be closer to $6 next year on the back of that. And the CyberTruck ramp, I think Gary described it properly. I do think they're going to start, as Alexandra said, with the higher cost models. Those are the highest gross margin models. Those also let you exercise every feature on the factory line and within your supply base. So you have the superset. You solve the superset of issues on the highest gross margin set of models. And then when you start up the lower tiered versions, you're going to be at a much better velocity, yield, and run rate through the factory, and that's what you want. So there will be a drag on CyberTruck for margins in the beginning, but it's going to be low because the volumes are going to be low, and the Model Y volumes are going to be that much higher. So with these supply deals I think they're doing, with the lower volume start of CyberTruck, I do believe we've seen the trough in gross margins, and I think we're going to get a surprise in the second half.
Yeah. Alexandra? You're mute.
And here I am.
There you go.
Unmuted. So I have a couple of things. First of all, I can't even count anymore how many news we had the last couple of days of Model Y being the best-selling car. Iceland, France, England, Australia. I mean, it's just everywhere. And so I agree with Jeff. That gives them enormous leverage. You know, they're recognized now as one of the best automakers, if not the best one out there. Now, the second point I wanted to make is I really deplore that Christian is not here, because with my delivery numbers, I aligned with him because he was so spot on in the first quarter, and that was obviously the biggest mistake. So I wanted really to tell him off, but that was that. The one thing before I get to the numbers was the Gen 3 information that Jeff just shared. Herbert may know more about it, but didn't we hear from Walter Isaacson that there may be a Gen 3 line also in Austin? Was that not was it him? I just had a feeling that rumored yesterday somehow, and that obviously would give the U.S. manufacturing plants more negotiation power again. Now to my numbers. So since I started my deliveries too low for this quarter, I put them up now, and I put them up obviously significantly because the Model S and X were higher. So that brought my average selling price over 46,000 again. I was well below that. And the COGS are now for me slightly below 37,000. So that margin, in my view, is now closer to 20, 19.5, 19.6, somewhere there. And then using all this and going down the line, energy at 20% with the increase we hope for, about 1,000 mega packs deployed this quarter, I am close to the buck, right? So I'm much higher than Gary. And I know Gary already going, oh, don't do this, don't go so high. I know. But it's at this point, it's really math. And so I'm quite hopeful. And the only weak point I see in my numbers is really the estimation of the costs, because how quickly did the economies of scale trigger through? How far are we in that? I remember it was about October, November, when Elon said it would take 6 to 9 months. So we could be there now or not. So that's my big question there.
How did you incorporate the discounting that went on at the end of the quarter, though?
Yeah, I agree with you. And that's a big question of, how many of that was it? And was it $750 per car or not? I agree that's a biggie. How many of those were discounted and not? That's the whole problem with these discounts. You just don't know exactly how many are affected by it or not. Yeah,
big number though, because Model 3 was about $3,000, and Model S and X was over $5,000, and Model Y was, probably about $500. It wasn't a big number, but you got to make some assumption about what percentage of the volume moved at that discount, and I don't know that answer, and that's why, I'm going with an 18.5 margin because I just want to be conservative on it.
Yeah, I mean, I see where you're coming from, and you're probably right. And again, the earnings call could, ruin all my hopes that I'm putting in these numbers. There's no doubt about that.
All right, let's
go ahead.
Xander in the conversation before we lose him. He seems to be popping in and out. What's up to you?
It got all glitchy. Well, like I said last week, I think it's a shot in the dark, but I'm still at 18.69. So I'm happy to hear Gary's right where I'm at.
Okay. And then what about your estimate for the earnings per share for next year?
We were saying like 8 was really high once they reduced the prices. So again, I'm not modeling it like Gary does, but I think around 7 would be
wow,
should be attainable.
That'd be huge.
Yeah. So my comment would be just that you guys are taking the existing business car business, you're taking existing margins, you're kind of layering out there, you're adding in things that you know about.
Hey, Xander, turn yourself in.
I think it's
coming from Gary, I think.
Gary.
Yeah. I'm going to
Gary.
pause, mute you, Gary. So, but you guys are not putting in things that I am going to put in, which is obviously some sort of FSD take rate is going up, regardless if it's an actual robo-taxi or not. It's going to be shown that it's working much faster than we realize. We're going to be surprised, of course, with a bot. I don't think that's going to add anything to the actual numbers or anything like that, but it's just, this will surprise us in the stock. And I do think that there's going to be continued cost reductions in the auto gross margins and operating costs. And then, because all of this was happening, I know, you probably have the greatest finger on the pulse here, Jeff, but you've been saying, we've been following this for a couple of quarters now, that it should really show up now. And I think we're going to start seeing some of that appear this year, this quarter, this, and so forth. So I'm pretty bullish about this thing. So I think it's going to start happening. And then, of course, we can't forget the fact that the biggest thing that's impacting both sales and the stock is the macro. And if macro stays where it is at, easing concerns, people are pulling up money from their mattresses and starting to put into the Magnificent Seven. We're going to start seeing more sales of the cars, the high-end cars at this point than we have been, because people are less afraid of what's going to happen in the future. So I'm pretty bullish. I think things are going to move back to where it was before. I think we had a dip for one quarter, and let's hope that that's what happens.
What's your number, Herbert?
Well, I've been saying, kind of ridiculous. I know when I talk to this group, you guys can all laugh at me, but I'm a 20 auto gross margin. And I'm just saying that because I do think that, when you listen to the conference calls and they talk about, cost cutting in every area, it just feels to me that that's their primary objective, is continued cost cuttings in every department. So I'm hopeful that we get back to that. Now, price cuts is massive. So I'm not 100% going to say this is going to happen. It's a little bit of wishful thinking there. I agree. Yeah.
And Gary, what do you think about the Fed? Do you think the Fed is, what does the market expect, and what do you expect?
Market expects the Fed's going to raise in this month, in July, and I think the meeting is like the 25th, 26th. So you got a couple of weeks, but we saw a huge ADP number today, and we'll see what the official Department of Labor payrolls number is tomorrow. But if you get a number like in the 400s, like you had ADP, which is private payrolls, the Fed's going to have to raise in July. And, that's pushing car payments up. It's pushing mortgage payments up. It increases the risk of, a systemic event with the banks, because you get people disintermediating the banks because, their deposit rates are so low relative to what they could earn by sticking it into a treasury bill. So it increases the risk of a hard landing. And it's not just our Fed. It's Bank of England's doing it. ECB's doing it. Japan and China are not, but Europe is pushing rates up very, very quickly. So I'm not feeling great about that at all, because I do worry you're going to see a big number tomorrow, because ADP, the number that came out today was huge. So.
Yeah, but that's a good thing, right? People are
not good if they keep pushing rates up, though, because then you push us into a hard landing scenario where you could have a recession, you could have a systemic event, and if you have a recession, everybody here is going to have to take their numbers down for next year. And so one of the things,
saying this for months, everybody's saying there's going to be a recession, and so far jobs are still here, houses still up. Anything can trigger it, and that's the warning. I agreed, but at this point, this is actually good news. Okay, so that this means that people have money that they're, to buy things, and yeah.
But remember why the stock market's up so much this year. This is the best beginning for NASDAQ since they've recorded it, because people expect the Fed to pause. They're not assuming the Fed's going to keep raising rates, and if all of a sudden the Fed raises rates in July and signals more to come, NASDAQ isn't going to keep going up at the rate it went up in the first half, and it's going to probably bring all the growth names down. Just remember the math. As interest rates go up, growth PEs have to go down. It's just a mathematical equation, because you're basically bringing the risk-free rate up. If you think about your PE formula, it's 1 divided by R minus G, and R is, you could say that's the return on equity, but it starts with the risk-free rate. And if the risk-free rate goes up 100 basis points from where it was, that's going to bring PEs down, and that's going to cause NASDAQ to not do well. It's going to cause Tesla stock price to not do as well. So I just worry.
You agree, though, that a quarter point is built in, right? That's expected to become a quarter point. You're just saying if it's more than that, right? Yeah.
Well, and it's the signaling, right? So the Fed, signals at each one of their meetings, and I'm in the camp that the Fed's going to break things. If they push rates up too high, we saw, 3 banks fail earlier this year. There's more that, were in trouble, and you had, JP Morgan and other banks contribute to, help them out. That's a challenge that's still out there. And I just feel that the Fed has to be really careful about pushing us into a situation that it's like, when a rocket comes down, you can't just you stop it right where it's supposed to stop. When the economy comes down, you can't just stop it and say, okay, stop at 0, because you're pushing on it. You're trying to stop the economy from growing so fast by pushing up rates, and you've got, monetary shrinkage right now. M2 has been shrinking, and it hasn't done that in 60 years. Well, the Fed, they're using these blunt instruments to control the economy, and they're not, as they'll tell you, they're not really good at that. They're not good at forecasting. So to bring it to 0 and then stop the economy at 0 would be great, but that's not realistic. Usually once you start, pushing the economy down through, the monetary contraction, which you've seen, and interest rates going up, which again hurts prices of homes and payments on homes, hurts payments on cars. People will stop spending at some point. And I agree with you. We haven't seen that yet. Unemployment's the lowest it's ever been. And, you're seeing job creation at a rate that's really, really huge. Again, looking at the ADP numbers today. So I agree with you that the chance of recession here just seems remote. But if the Fed keeps pushing rates up, it increases the odds that you have a hard landing. That's my worry.
Anybody else?
Yeah, just going to mention, just if you go a little bit sub-macro from macro, go to auto. In U.S. auto, it's pretty strong through the first half. I think it was 7.8 million cars. I think that's still being tallied. But Cox Automotive, other reputable sources have increased the SAAR for the year. I think closer to 16 million now. So it's been elevated in the first 2 quarters from previous forecasts. I think GM, thinks it's going to be 16 million now. So at some point we're going to get through some of these pent up supply purchases of, people that have been wanting to buy cars for the last couple of years, but haven't been able to find them. I'm wondering when this exhausts, because, the rates right now to buy a car are literally more than double where they were, I think, a year ago. But it just doesn't seem to be having an impact. The average car payment's up. The rates are more than double. But if you look, we're having just a phenomenal first half. I think it's gonna be interesting to, can you forecast when this rolls off or not, and what are the implications for Tesla? Because I think Tesla came into this year with a darker scenario where Ford and GM, I think, were not.
Well, also Ford and GM have their own financing and have done all through the first 6 months incredible deals, right? They had 1% financing, 2% financing, 3% financing, while Tesla still does large majority of its financing with banks who have been somehow reluctant to give more financing to Tesla customers, because with the car prices coming down, they find themselves with a book value that they have to write down quickly, just because they suddenly have cars on their books that are not worth what they financed them for. For Tesla, it was not ideal, just because they're not proposing the same financing deals, and they still don't seem to be willing to do so. While the other players gave up some of their margin, which they traditionally had actually in the financing arm. Remember, we discussed 6 or 8 months ago how GM and Ford actually makes more money on the financing of their cars than on the cars themselves. Well, they gave up some of that margin to keep the whole financing arm fluid, and hence didn't have the same stress from the interest rate scenarios.
That's a great point.
Okay. So we've covered Q2 and the margins. July 19th, they're going to do the earnings call. Gary, I'd be curious what you're thinking. What are you thinking for Q3? Let's look forward here. What do you guys all think about Q3? Start with you, Gary.
I think Q3 is going to be a little bit better than Q2 because the volumes will be a little bit better than Q2. But I'm more interested not in Q3 precisely, but what people think about next year, because you got two things happening. You got the CyberTruck launch, which will be like a halo effect for the entire franchise, right? Which is what happened in 2020 when Model Y came out, and that's what caused the stock to go up sevenfold. You got, bears saying, well, not bears, but Tesla Q says, no, the reason the stock went up 700% in 2020 was because of all the, the quantitative stimulus by the Fed. And that's not really true. What happened is the volumes, if you look at the volume growth in 2020, it was 36%. And in 2021, it was 87%. And I think you're going to have a very similar situation to what you have this year. Volume this year, if they hit like 1.8 million, will be up to 40%. I'm looking for about 53% volume growth for next year. You know what the street's looking for next year? 27. And so you got CyberTruck, which will be a halo effect for the entire Tesla franchise. People will see the CyberTruck, they'll go to the website, they'll say, I want to learn more about these things called Teslas. Because remember, it's got 2% market share and only 10% of people drive EVs. And then the second thing that happens, which people are really putting a lot of lip service as, that $7,500 EV credit turns into an instant rebate. You could take it right off the purchase price. So if you're getting a loan, and let's say a Model 3 is, let's call it $40,000. Now it's $32,500 that you're financing. So even though interest rates are higher, your payments are going to be lower. So I think those two things could really accelerate volumes next year if we're not in a recession or it's a very light recession. And that's what keeps me very bullish, is that you've got 2024 that's shaping up to me like what 2021 was, where the volumes just exploded in 2021. They were up, again, 87%. I don't remember what the street was looking for at the beginning of the year, but I bet it's very similar to what the street's looking for next year. I don't know why the street's looking for 27%.
Can you explain to me what matters more? Okay, you guys keep talking about margin compression versus volume. We are going to get 50% growth. We're going to get to the 1.8 to 2 million this year. We got 2 gigafactories scaling. They're going to produce many, many cars. And then they've already said that they're going to reduce the price cuts to sell all those cars, whatever the macro is, they're going to sell it all. So for me, like the volume, both production and delivery, I'm very comfortable we're going to get to the 40 plus 50%. But then you guys say, well, even if they hit the 50%, what matters is the margin compression. That's what matters. Which is it that matters more?
You want both. You want, and nobody expects, by the way, nobody expects 50% volume growth. People, I think, would be happy. The street's looking for 41% this year. And I would be happy if we got 40% this year. But with CyberTruck coming next year, I would expect the number to accelerate, into the 50s. So, yeah, we need to see stable margins. We need to see, because there's all those rumors about price cuts and discounting already in the third quarter. You've seen it in Australia. You've seen a lot of discounting in Japan. There's a kind of a truce been called on the price war in China, which is a good thing. In the U.S., while we do see some discounts on Model 3 and S and X, you're not seeing big discounts on Model Y. So I'm optimistic, and that's what institutions look for. Are there going to be more price cuts, or is this just kind of sporadic discounting that's happening because you're launching a couple new products? And I'm hopeful that, and that's what I'm looking for on this earnings call. And to Alexander's point, that'll determine whether the stock goes up or down after the call, assuming they do beat. Do they give good indications that the margins have actually stopped falling? Because let's face it, the reason the stock got smushed last year is people expected that there was going to be more big price cuts, because it started in China. And then, of course, you had Elon selling shares. But I think the fundamental reason the stock got hammered last year is because people were worrying about pricing. And so year to date, 2023 estimates are down 35%. That's a true number. 2024 estimates are down 27%. You got to see that stop for the stock to continue to run. And that's what people are anticipating. So to answer your question, we need both. We need margins to stabilize here and start moving up slowly. and they need to put up at least 40% volume growth this year. And then I think the stock can continue to rally.
Anybody else want to comment on that? Okay. So I want to ask another question then, Gary. So, we talked about Q2 margins and Q3. You guys are all big numbers people. We kind of identified in this call right now, just now, that few investors are putting in any kind of credence to FSD and bots. Why? So
why? Because Elon has. Yeah, go ahead. I'm sorry.
Let me just complete my sentence here. Like in the last month, this last month, we have quite a bit of new information that's been shared, right? We got Ashok and Paul Duan coming out with videos explaining the incredible progress that they've made with being able to do a generalized model that now can do 3D reconstruction simulation. That is just, and then you've got the news about Dojo coming out, supercomputer that's going to become the largest supercomputer by the end of next year. It's going to be the 5th largest computer by January. That allows you to take all that data to put in. They're feeling much more confident. Now, I grant you, that's fine. You don't need to tell me that FSCs can happen this year. That's fine. I totally understand it. You could push that one. And then you see bots. You saw the demo. You saw these bots are progressing really quickly. Then you add the fact that you have the supercomputer, and then these videos by Ashok basically confirmed, they basically said that they can now use the same neural networks, hardware, software that they're using for FSD, transferable to the bot. Today, I doubt that you guys are putting that into your models, but what bothers me is you won't even put in for 2024 until it's a real thing. Otherwise, it's like fairy tale stuff that won't happen. I guess that's why I'm an investor. I'm looking for these things, and they are becoming more real every day. This is not just pie in the sky stuff in my mind.
But they're conceptual. They're not. There's not a number you can put on it. And it's like, take robotaxi. Every model I see out on Twitter is they say, okay, you got a car. The car can work 8 hours a day. It gets this much cents per mile. And you put a value on that, and that's robotax, and there's a take rate that Tesla takes of it, make 25, 30%, whatever it is, and that's the number. There's no demand in that equation. It's all supply based, and that's silly. That's like saying, well, every car that Tesla can produce is going to flow through the P&L, and therefore we're going to count it as a delivery. That's not real either. And so I get very frustrated when people just look at the supply side of robotaxi and they forget. There are a lot of people that are going to solve, we'll call it fully self-driving. And it's, I know people say, no, that's not true, but you're already seeing it. You're seeing it in China. You're seeing it in California, and they are geofence type markets, but you will have others come up with, fully autonomous vehicles at the same time. So you have to factor in, there's a market, and then Tesla will have a certain share of that. And then you got to figure out a valuation that way, not just do pie in the sky and, just take number of hours in a day times cents per mile, and Tesla has 100% share. And I think that's the frustration that many of us have with a lot of the models that you see on Twitter. They're not looking at the demand side of things. They're just assuming that Tesla gets 100% share. And so that's why I don't build it in. And look, I always try to be conservative. I don't want to put in something I can't estimate. And I get the concept, but if you can't figure out how much volume you're actually going to get, how do you put it into your estimates? Like, I challenge you. Tell me how you do it.
I've got so many answers to you, but that's probably not the right time for me. And but I shake my head when you're talking about when you say.
I don't see it in street estimates though. I don't see a model. I see. Yeah, they all wave their hands and say conceptually there's going to be robotaxi and conceptually there's going to be bots, but there's no demand side where you say, here's the TAM, here's Tesla's market share, here's the pricing, here's the cost, and therefore here's how much money they're going to make. I don't see any of that. I just see this conceptual framework that's supply driven, and that's frustrating to me as an analyst. All right. Alexandra's not smiling. That always makes me nervous.
Not. Usually I always am. But the thing is, I feel, I hear where you come from, that this is not tangible and you can't put it in an Excel spreadsheet, and you can't just say Tesla has the whole market, because
It doesn't have to be Excel spreadsheet either. Just give me a formula that I can like build into a piece of paper. I don't have to put it in a spreadsheet.
The question where I agree with you, we don't know how much of this will be adoptable, right? How many people will really use their phone to bring a driverless car to their door and drive them somewhere? If you have problems with imagining that concept, you won't give it any value. If you feel very comfortable with that concept, thinking, I just pushed a button, 2 minutes later, no matter what car comes, or I pre-select I want a CyberTruck or whatever. If you start believing in that, it just gets very quickly very big in numbers and expectations, right? But as long as we're not in a completely driverless environment, as long as Tesla uses this level 2 categorization, which I think is very clever of them, we're not there. And so I understand why you don't put it into this year or next year. I don't understand why you wouldn't put it into something in 2026 or 2028 or 2030, because it will come. It will come, and it might even come with competition or not. So if you give it the same type of market share that the cars have, let's say you give them a 20% market share worldwide, or even 10% market share, then they would also have at least that market share in the robotaxi business.
Yeah, I think oh, sorry, Gary, go ahead.
No, and then we still have, Ross running through stop signs, and, so you still have the pundits saying you're not at level 4 yet. So you could say you're level 4, but you're not. I mean, that's
okay. I don't know if we should turn this into a debate on robotaxi. I'd love it to do a one-on-one with you. There's so much I can answer to everything you just said. I don't want people to that's fine. That's fine. This is how you think and your opinion, and that's fine. That's why I was asking you.
Well, the one thing I can just comment on is just the competition, and the one thing you can model is what are the unit economics of the vehicle that's actually delivering the robotaxi. And today it's inside of every Tesla today, and it's arguable maybe there's a plus or minus a sensor or plus or minus a camera change, but Tesla's actually built the only, I believe, truly globally scalable system. When I say globally, meaning like, yes, it's going to go out on roads and learn, but also the actual hardware cost structure of the vehicle, they call it the subscriber base of FSD, is manageable. And if you look at these robotaxi services, whether they're in China or whether they're the small geofence services in the US, and if you look at the aggregate cost of those vehicles, they're enormous, with all the sensors, the cost to manufacture them, the cost to calibrate and tune them. I don't believe that those systems are actually scalable in their current form. I believe they have many, many, many revs in front of them before they get to something. And it's not just going to be getting more volume. I actually believe their cost structure today, their unit economics, are at a point where you wouldn't want to build millions of those things, because there isn't a per unit or a drive that you can actually get it down to that would be meaningful for consumers. So if you look at what these driverless units, they're printing billion-dollar losses. Fairly significant.
All of them except Tesla. All of them.
Yeah. So I think the one area, and we can go into a different and have a whole different show on this, but the competition not only has to catch up technically, but it has to be at scale, both geographically as well as scale from a unit economics perspective. I just haven't seen that recipe from the competition.
Yeah. So quick point is that there is a economic model that's already out there. It's the ride-hail services. You could take that. Is Uber a real business? Take a look at that and do that. They do not need to own 100% of the market. The service is so large that you can just own pieces of it and have significant impact to the balance sheet and to the income statement. The other point is that what Jeff just said, the LiDAR cost is so expensive, prohibitive. And then if you watch Ashok's video, they've now confirmed that this general 3D reconstruction model, the world model that they've created, can now act as good as high fidelity as LiDARs. They can tell you the number of centimeters the curbs are at. This is multiple cars, Teslas, driving through a certain street and capturing all those videos, turning it into a 3D reconstruction, and then they can do predictions forward and backwards. But anyways, it's not, again, I don't think this is a conversation. What I wanted to just ask you today is, right, bots and FSD, Now you have added energy, correct? And that should then start rising up. And so shouldn't your 2024 be higher than your $5.40 if you now add in the $2 billion of profit that Tesla's going to have by the end of this year in energy?
Did you hear how he slashed you the 540, Gary?
Yeah. But why be greedy, Herbert? I don't get it. I don't get if the street's at 480 and I'm at 540. Why would you want me to take my numbers up? That makes no sense. Because
I don't base my number based on what other analysts do. Sorry.
Right. I just find it a very strange type thing. Like, I grew up in a place where if you're ahead of everybody else on the street, like you don't want to be so far ahead that you're going to set yourself up for disappointment. Yeah. And so I look at it as I'm at 540. I will probably go up after the quarter, assuming they don't blow us up on their gross margin outlook, which they may, because they may decide they're going to, cut prices again, for all I know. And, I could get higher than 540, but I don't understand why you'd want to be going up to $6 or $7 or $8 when everybody's at 480. I don't get it. I don't understand why you do that.
I actually think I'm happy that you are, because we want the analysts, we want the expectations to be low. So that's fine. As a retail investor, I'm not playing that game.
Look, if you, I talk to a lot of institutions and I talk to a lot of retail investors. My view on institutions is not that they're overly conservative. They're trying to get, be realistic. But my view on retail investors, they're exuberant. I mean, look, all the time they're exuberant, and they always think everything's going to be great. And you can't just assume everything is going to go perfectly, because there was a price war in China. Estimates are down 35% for 2020. How many people expected that this year? I didn't. And for 24, they're down 27%. I didn't expect that either. And so you got to build in some modicum of conservatism into your forecast, or you're going to get blown up. And that's the problem.
I agree with
Tesla. It's why a lot of institutions don't want to own Tesla. It's why Warren Buffett's not going to own Tesla, because we have a habit of getting too crazy about our estimates.
And remember, I think on Monday, I sent a poll out asking people when they expect the stock being back at 400. And I didn't comment. I just put the question out there. Nearly half of the 8,000 people that voted thought it was going to be in the next 6 months. And I mean, 300 I can see, but 400 really everything has to be right? And I mean, I see that China is in June now on a run rate well above 1 million. And I see the good news as well. But 400, that is far to go. And that is very close to the all-time highs when we're in a completely different macro environment and had completely different expectations. So there is certainly one point that Gary makes that is correct, which is retail is overly optimistic, especially in how quick the results will come and filter through to the stock price. So I always caution everybody, patience until we have it in the stock price.
Yeah. One of the things I look at in these situations, though, is I look at biases and I look at tendencies for where they're going to move. So if you're thinking about COGS, for example, COGS, if we believe COGS have troughed in this quarter, then you have to believe that the bias is going to be to the upside for a surprise. They're not going to slow down event-driven cost reductions. They're not going to reduce their leverage with their supply base. There's no scenario that does that. So first off, at a top level, I agree with you. Retail tends to overshoot in some of these examples. And I think institutions overshoot. They overshoot to the downside, and then they chase it upwards too. So there's some of that happening. But if you look at the biases, everything's starting to trend in a better direction for Tesla. The price war in China is for in most parts over. You have the street being very low on CyberTruck. They're pretty low on energy. And if you look at all these biases and all these tendencies, the meter tends to switch and turn to the right. Whereas if you're looking at this last year and you're saying, wow, I think we're a little bit high on volumes. I think we're, there's all these unknowns in the economy. We didn't know how high the Fed was going to go. We know how high they're going to go this year. We have a pretty good understanding of what they're going to do. So I think things are starting, when I look at these biases, things are really starting to move in favor of Tesla. I agree with you. Bad things could happen. Something could happen. But I tend to look at these biases, whether it's gross margins, whether it's COGS, whether it's units. That's the other thing. Look at the competition. They're not participating. All they're doing is supplying lip service and saying that they're going to grow EVs by X, but they came in all lower than what they guided even for Q2, at least the US automakers did. So I tend to look at these biases, and I tend to think that they're kind of leaning in Tesla's favor. It doesn't mean take your 540 to 6. It just means that I'm a little bit more confident in them continuing to improve from here versus continuing to degrade.
Yeah, and I think the other thing with the retail investors is they were so starved off. I mean, the last 10 months have been difficult for Tesla retail investors. So they are a little bit over greedy now, which I think is understandable and probably will come to some reason after the earnings call on the 19th. Could go fantastic, but could also be, cold shower. And I think from there on, we'll probably be on more stable grounds.
So I wanted to just say, Gary, I appreciate you so much. I really do. And you're absolutely correct. People like me and the retailers, we're optimistic. We're more long-term views people. So we just always want to be more positive. And I do really, really respect and appreciate that you are here. You are an analyst. And so you need to kind of like lead the charge of the other analysts. You're so much more on top of it. I'm so happy that you show up on CNBC and tell the Tesla story. You do a fantastic job when you do that. So I'm not trying to make you move any further. I'm happy where you're at because that's exactly where you should be at.
And we're bullish. We
I know you are. Yeah.
We when everybody else was cutting price targets, we kind of stuck with our 320 price target. Now people are saying, well, you should be taking it up. Maybe, but I'm going to wait until earnings. It's a couple of weeks, and let's see what kind of outlook they give us in gross margins. And to your point, I'm looking at where energy is versus the street, and I'm $1 billion ahead of where the street is. Once I get to 2025, and so that's worth a lot. But the other thing that you got to think about from a negative standpoint, the reg credits are going to go away, and so they'll do $1.4 billion in reg credits this year. I've got to drop into 600 next year and then 0. So that's something that feeds through earnings. So you have to factor that in. And I'll tell you, the biggest wild card for me is the pricing. It's trying to figure out what the average selling price is going to be. And again, CyberTruck should bring it up, and what the auto gross margin ex reg credits is going to be. That to me are the two drivers, and volumes, of course, that if you can get those right, you can get the stock price right. And then look, energy, it's still very small as a percentage of the profits. It's like 5-6%, but it's going to get much bigger. I agree with that. Mm-hmm. I just, until I see, the capacity actually come online in Shanghai for megapacks, I'm afraid to just be too aggressive in my forecasting on energy. So I'm just trying to.
What's your reg credit for this year? Because given the low volumes of everybody else, I expect a huge reg credit in Q2.
Yeah, I have it at 1.4 billion
for the year, right?
Yep. And so I think for the quarter, probably 3 something, just divided by 4.
And I'm 5 something, close to 6, and the numbers this morning from all the competitors give me quite a lot of comfort there, because I mean, money has to go somewhere, right?
Yeah, I'm at 400 for second quarter, 300 for third quarter, and then I bring it down to low 2s for fourth quarter. Because that's what Zach will tell people, that they think the reg credits over time are gonna go away as everybody else builds more EVs. Sure. But you're right. At this point, competition's not showing up. They keep saying they're going to show up, but they're not. So, in theory, the number could be much bigger than 1.4 billion for this year. And then I've got 600 for next year. That could be a very low number if they don't get their EV production up, which
exactly.
They may not.
Exactly.
So I'm just trying to keep my numbers in check. How's that?
I know.
Okay,
and I mean, I appreciate that you're prudent, because we're all greedy.
Yeah. So we covered a lot of topics on Tesla. We've already covered some of the macro and the Fed. I want to hear more about your forward fund and your new fund. But before that, Gary, can you tell us in the stock market, the AI boom, this AI narrative took over. The 7 Magnificent 7 has gone up. We're now seeing that narrative spread to the other 493 companies. This AI narrative is real, most people think. This is bigger than the internet. It's going to improve productivity, and it will show up in earnings for some people think the end of this year for many companies. Do you think that Tesla is being viewed as an AI company? Do you think that there's more of that might come? What's your thinking about the AI?
So I had this debate without going into his name, but somebody I respect who's a Tesla Q person, And his bold claim was that the reason Tesla is up 130% this year is because of AI. But this same person said that the reason Tesla was up 740% in 2020 was because, you know, the money supply went through the roof as the Fed was trying to bring us out of recession, which we know is not true. There was a halo effect in 2020 and 2021 due to the Model Y. And I think the reason I think Tesla has done so well this year is because people say gross margins are going to bottom in the second quarter, and you're going to get CyberTruck in the third quarter, and FSD continues to get better and better, and you're going to have a Model 3 refresh, and you've got all these charging agreements coming in. I don't think it has that much to do with AI, because AI is not a big, as we just went through, it's still not a big number. And so when I build FSD into my models, I take what I think is a good take rate. I'm assuming a take rate of 10 to 12%. As I go out a couple of years, I multiply that times 15,000 for half of it, and I multiply it times $199 a month for the other half, and I build that into my EV numbers. I don't come up with a separate FSD line. And what Alexander was giving me a hard time about, which is fair, is I don't build in a robo-taxi P&L at all. And if it happens, that's great. But if it doesn't happen, I don't want to have to take it out. And so I guess the way I'm looking at it is AI is a factor. You can't deny it, that when NVIDIA basically said we're going to do 11 billion in revenue instead of 7, Tesla went up dramatically on that day. And so you got to accept that AI is a factor. And after the May 16th annual meeting, and you saw, all those robots, people believe it. People believe that they could take all the learnings from FSD and from Dojo and apply it to bots as well. But again, until you have, a TAM and an estimate of how much share Tesla can take of the robotics market, it's hard for me to build some number in there. So I just don't think from a percentage of revenues or a percentage of profits, it's going to be a big deal versus EVs. I think it's something to consider. But to put an AI multiple on Tesla, which on my numbers for next year, it's 51 times, PE is 51, I can justify a 51 PE based on 37% earnings growth that I get just in the EV business. And remember, for my 2030 estimates, I'm assuming that we have 10 million of Tesla units, which would make Tesla the biggest car company in the world. It'll pass Toyota. If the global SAR is 80 million, that's what, 12.5% share? That's bigger than what Toyota is. So I don't think I need robots or bots, to justify a 51 PE. So I don't think that really reflects that much of an AI part of the business, and that's my view of as an institution.
That's great.
Which is a real good silver lining. Which is a great silver lining, because if analysts and Wall Street doesn't filter in AI into the Tesla price, we have the whole upside. I mean, we know it's coming, or at least we all believe it's coming, and quicker than we all think. I mean, we've seen yesterday the job offer in Sparks, right? You want to bring that in, Herbert? My gosh, we're so coordinated, Herbert. That's it today. So that's the line lead for the Tesla bot in Nevada. And the job description that was with it was very precise. Was very precise in what this position is for, and it is for now. It's a full-time position for now. So this may be still months or even short years out, but they're building up a team. While I do believe initially everything was handmade in Fremont, this is now the first step to industrial manufacturing of the bots in Sparks, and so this is coming. May not be there in 2024 yet, but I think 2025 you can reserve a line in your analysis, Gary.
How
Exactly.
Wait a minute. How come it doesn't bother you, Alexandra, that Elon's been predicting that the Tesla will drive itself since 2019 every year? And here we are,
Can I explain
2024, maybe that'll happen. And I'm accepting that Tesla will get there, because it does, again, the Cook's Corner stop sign incident notwithstanding, I think it will get there. I just think that other people will get there too, and maybe I'm wrong about that. So how do you justify that, they've been saying FSD will be self-driving, fully autonomous, level 4 since 2019, and here we are 5 years later, and we're still not there yet. How do you reconcile that with your bot in 2025 forecast.
Can I don't know.
Yeah.
I don't
Please
want the
do.
show to be on this. We need a whole long show. I'm trying to keep it short.
I know. I'm
Okay.
sorry.
So you do understand, and I know you do. I don't want to say it in
Yeah.
a certain way. You know that this is not heuristically coded software, right? It was. Now they've moved it to software 2.0, which is neural nets. This neural net is learning on its own.
I
Right?
get that.
Okay. So if it was coded software, then it's very linear, right? There's code. Whenever you see this, act this way. When you see that, act this way. And then they're going to knock it out one feature at a time. And that's what people think when I'm driving my FSD beta and I press my disengagement. Now the fleet knows, now they're going to fix that phone. Okay. Now what we're doing is switching over to neural networks. This is a system that's learning on its own. So when every year, so first of all, just to be super clear, when Elon started saying that FSD will be solved, when he started saying that in 2015, 2016, 2017, and 2018, those years he was referring to autopilot on highway. And he was correct. By 2018, autopilot on highway, most of us believe that it's pretty good. It's solved. We are very happy with autopilot on highway. Then he did, I agree, give it to you, robotaxi, using those words, million miles. By the end of this year, he started saying 2019, 20, 21, 22, 23. So people are tired of him saying that. The reason he says that is because you've got this neural net and you think that it's going to learn on its own and the exponential curve will rise up to the fact that it will just solve it. So this is how this works, right? It's very slow. And then all of a sudden, the system figures everything out and all the features will be solved very quickly in a month. Okay, if you go back to how Go was beaten by DeepMind's AlphaGo, initially they let the software, the neural net, watch all these human players play, and then they taught it how human players played, and then it learned how to beat the best player. Then what they did was they built a new version of it where it was all neural nets, where they didn't teach it anything, they didn't tell anything. They just said, here's the goal of Go, and what the system did was just play it against each other. And of course, they can do a million miles in that. Within days, it was way past humans. And it happens like this. It's like slow, and then all of a sudden, boom, it gets it, and then it's taken care of. So that's why he thinks. And then he says, well, he didn't realize that each neural net that they created, there was a rate limiting step that it hit, a threshold that it couldn't get past, which means they'd have to rebuild the neural nets all over again. And whenever you hear that FSD version 11, version 12 is rolled out, there's always two steps backwards because it's like a baby, right? You just launch a brand new baby, you erase all its memory, and it goes back out and needs to relearn things on its own. And that's why people don't understand. Why is it regressing? Didn't we already teach it? The stop sign? How come it can't recognize that stop sign anymore? And so don't be confused whenever you hear this one-off things that, oh, it still can't do stop signs. It's still making those issues because didn't they already solve that years ago? And that's this. And then, so if you watch this video, please watch the Ashok video and the Paul Dewan video that just came out. And the best way to do is watch John Gibbs, DrKnowItall, because he took those videos and he will stop and explain it to people like me to understand this. Yeah. And you will see now that this system can actually now,
exactly,
it's all together, including the Dojo supercomputer. And then here's the kicker. When he was asked, Ashok was asked by the Q&A session, when is this going to be in customers' hands? He paused for a long time. He himself says, I think it might actually happen by the end of this year. So it's one thing when you hear Elon say it. It's another thing when you hear the engineers say, I actually think, now when this happens, if you see this thing, it is predicting, it's not just predicting the lines, the street lines, but everything is capturing everything. But now we can create it like a video game. So I don't know if you know this, but you can go into Tesla supercomputer and say, show me San Francisco. And you can basically go like street map, like you can go to any alley, but it's like a video game. It's all been recreated precisely to the millimeter, to the centimeter, trees, signs, mailboxes. It's got it because of all the cars that's ever driven through it. And then because they have that created, they're able to now play it like large language model, right? The ChatGPT model, the way that works is that, you feed it all the words and then it predicts the next best word that should show up and then it creates sentences for you. That's what this is now able to do. It's able to take all that recreate as a game, as a simulated, reconstructed game, and then predict the future of what can it do. So, anyway,
and let me maybe add. Let me please add something, because you brought up Crook's Corner, right? And I spent obviously the last 10 days of my life on that stupid situation. So that happened on that Thursday. We knew about it on the Saturday. By Sunday, I drove up there, and by Sunday, all the Teslas that came up here and helped me and had the same version made the same error. By Monday afternoon, the ones that were still here, none of them did anything differently. By Monday afternoon, the situation was much better. And then by Tuesday, it was solved. And since then, people that had similar stop signs all over America find them to be solved. When you explain that to people, that a situation was created, got some focus, and it wasn't somebody just now in the headquarters saying, okay, now you have to slow down, because this whole solution suddenly applies to stop sign in completely other regions of America, because that's how the system works. So we're really getting very close. And I understand that people are getting impatient and say, oh my gosh, it's been promised for 8 years or 6 years or 4 years or whatever. It will never happen. Well, that's typically how technology works. When nobody believes it will happen, then suddenly it will happen. So I do really think people that have FSD and want to try it, and I invite you, Gary, I know you're coming to California next month. Let's do Crook's Corner and you'll see how it works.
I'm sure it's solved. I have a bigger question. So hardware 4, you've got 4.5 million Teslas using hardware 3, and now you got hardware 4 with 2 extra cameras and a high def radar. So everything you just said, Herbert, does it have to have hardware 4 in order to work? And what happens with hardware 3?
Yeah. So he did confirm. No, but Elon did confirm that there's no upgrade path for hardware 3, but he also confirmed that you will be able to do full self-driving with hardware 3. My suspicion will be that there will be restrictions on how that would work. It might, they might just say it only from, I don't know. It might be a little, like, you might not be able to, if it did it, it won't do any of the complex, unprotected left turns or something like that. It'll find a different way, a different path. I'm not sure how that would work, but
will it work? Will it work the same as the hardware 4 package? That's my question, because you got 4.5 million cars out there with hardware 3. So what do? You say those cars aren't going to be as good as anything with hardware 4? That just seems.
Well, I think it's at the margin. It's hardware 3 will have a slightly lower safety, 99.99 whatever percent than
so
hardware 4.
So it'll still be level 4. It'll still be level 4 autonomy.
But that's the objective. I think so. Yes.
But is that true? Is that going to be a true statement?
I do not know.
Well, do I know whether it's true? I don't know.
Okay, well, that's something we should find out. It's an important question. Because I don't know.
Who's going to ask it at the earnings call? So the question is, should Elon be there? We're back there. But we have a couple other subjects, Herbert, right?
Sure. Let's, share me what you're doing with your Ford Fund. I saw that you launched this Ford Fund long-short ETF. Alexandra, you did this tweet. Why don't you explain to us what this is all about?
Future Fund.
Exactly. Future Fund, not Ford.
I'm sorry, wait. Isn't your company's called
Future
Ford Fund? Or
it's
you were called Future Fund? Sorry, Gary. Why do I call you Ford Fund? Okay.
I don't know. We're forward thinking, but Future Fund is definitely what it's called.
Sorry, Future Fund. Okay.
Yeah. So I did this tweet this weekend because I was, thinking about how could I bring some information regularly, I don't know, weekly to every 2 weeks, to the Twitter community about what Gary's doing in this fund, because it's a fund that for the long positions is quite similar to the first fund they set up, FFND, but adds to it about 40% of short positions, right, Gary? Is that the right way to explain it?
That's today. I mean, the goal is to be between 20 and 60% short, but we're pretty bullish on the market right now, the Fed actions notwithstanding. So right now we're at about 40% short, and we could take it up or down based on our view about the economy and on the markets. So you could interpret it as we're more or less bullish right now in the market, because the net position is 60%, and we could have that net position be generally between 40 and 60, and we're at 60 right now. So you could interpret that as we're pretty bullish. So keep going.
And so no worries. So this one I did, which was the end of the quarter, end of June, where I listed by size the positions. So your longest long is Alphabet, the second is Tesla, and then come the short. So in the car market, your long Tesla, BYD, Harley Davidson for their EVs, and Porsche.
Yep.
And your short Lucid, Polestar, Neo, and your biggest short is Toyota, right?
Right, and then for different reasons. So when we think about Toyota as a short, they're just being left behind. 1% of their volume is coming from EVs. They keep firing their CEO, who's supposed to be in charge. They're just way behind everybody else at getting EVs out there, and they have the most to lose if the world goes EV, which we expect 60% of the global SAR, which is about 80 million units. Back to what Jeffrey was saying before, we look at it globally. They are the biggest losers if they can't get an EV out there, or at least a bunch of EVs out there. And so we just think they have a lot to lose. Whereas like Lucid and Polestar and Neo less, but they're just not executing well. And Lucid has the backing of the Saudi Arabian, the largest fund in Saudi Arabia. And that's what makes it risky as a short, that they can always buy it out. And that's true of all the shorts. You want shorts that have, they're being disrupted, or the expectations are too high, or people think they're going to suddenly become profitable when they're not. But you want shorts that don't have high short interest, because when you have high short interest, like Lucid's about 15%, it could go up like this automatically if all of a sudden the Saudi government says, well, we're going to take the other 30% and own it. And that's the challenge with shorting. You want to avoid the shorts that have explosive upside. DWAC's a good example. That was, that's Donald Trump's. They had a SPAC that was trying to buy Donald Trump's Truth Social, and it was held up. And now there's been a settlement where three of the participants, in the whole side story, which you don't want to get into, they got charged with insider trading. And now the SEC is saying that deal can move forward. But I still don't see why Truth Social is going to get any revenues or earnings when you got Twitter. You now have the new, Meta, Twitter, right. Instagram, Twitter, whatever you want to call it. Right. I just don't see why Truth Social is going to suddenly get a whole bunch of revenue unless Donald Trump gets elected president, which is possible, I'm sure. So that's the type of thing we're looking for in shorts. We're looking for disruption. We're looking for expectations that are too high because of disruption. So you put Lucid in there, Polestar in there. Our number 2 short is Under Armour, which we just feel is not doing a good job in the whole fitness boom. Again, a laggard. They're not doing as well as Lulu or Nike, which we used to own, we don't own anymore. And then one of the other shorts we have that we think is pretty interesting is Federated Hermes. As interest rates come down, Federated gets most of its earnings from money market funds. As interest rates come down, we think people will put more money back in traditional products. So that's why we're short that. But we have a whole list of reasons that if you want me to go through on a different call, which you can listen, you actually listen to Alexandra's call from a couple of weeks ago. We went through just about every short in the portfolio and why we're shorted.
We did, yeah, on a Twitter space. That was actually very good. I agree. And I'm just for full disclosure, so I put $20,000 in FFLS. I really like the idea. I don't like shortening myself because you have to have collateral, and I just think it's complicated to do it. So I think this is a really good idea on an ETF if you want to have a position. I like most of your analysis on there, and very happy to be in the fund. I know it's been off to a choppy start the first 2 weeks, but I mean that's
flattish. Right? I mean, look, what we're trying to do is find more shorts that don't blow people up if we're wrong about them. And with shorts, it's hard because if there's a catalyst like somebody decides to make an offer for the company because it's so beaten up, like Neo. Somebody could decide they want to buy it. Snap, somebody could decide they want to buy it. When you have a high short interest, the stock can go up 40% in a day. We wanted to short Virgin Atlantic, which was they're charging $200,000 to $400,000 to go up in space and then come back, but we didn't do it because the short interest is like 24%. Well, that would have been a great short because remember the submarine that imploded, which was people going down to see the Titanic, and then the financing was not getting done. And so that stock's down about 25% since we launched, but we decided not to short it because the short interest was too high. So it works both ways, But to Alexander's point, it's FFLS, it's traded on New York Exchange. It's been trading pretty well, meaning the bid-ask spread's been pretty tight.
Yeah.
And again, we're trying to get S&P like returns with about half the risk. And so far we're down a little bit, about 1% or so since we launched, which is fine because the market's been kind of flattish. But we're hopeful that over time we can get S&P type returns with half the risks, and that's the goal. Yeah,
very interesting concept.
And FFND, for those of you who haven't looked at it in a while, it's had a terrific year to date. We're top quartile. We've been, Tesla's helped, and NVIDIA's helped. Trying to think of what else has really worked this.
Google, Celsius,
your #1 position.
Okay. Celsius has done very, very well. Chipotle's done very well.
Oh, yesterday Tesla was its #1 position for a day.
For a day.
I nearly had a heart warm. I was like, oh, good.
Yeah, we like Tesla being #1 or #2, but again, it's got a high beta, it's got high vol, and because I don't know what they're going to say on the conference call, if I had high conviction they were going to say gross margins have bottomed, and from here we're going to try to, firm up pricing, or they were to show us, to Jeff's point, the costs are coming down just as much as pricing has come down, then we would probably take it up. But
and Gary, get me right, because I know we're fighting over this quite a bit, but let me state it. I mean, I wouldn't be in FFND if I wouldn't appreciate your discipline and all that. I don't have that discipline. I can be easily convinced to throw even more money at Tesla, and that's why I do a part of my portfolio to FFND, because I know you're more disciplined about it. I may not get the same returns that I get on Tesla, which I hope for, but in bad moments, FFND saved me, right? And that's the whole strategy for me to diversify into your funds.
Yep, that's true. And so, look, if you have FFND, you've done well this year. It's up over 30% year to date. But it's unlike ARK, it's a very disciplined growth fund. 90% or so of the names in there make money, and the average PE is about 40. Tesla, on my numbers, Tesla's at a 51 PE for next year, but it's growing at 37% year over the next 5 years in earnings. So that's a PEG of 1.3. You look at something like Apple, which we don't own. I wish we did, but we don't. Apple's got a PEG of about 2.5. Microsoft 2. So we're looking for stuff that's cheap within the growth universe on a price earnings to growth, or as a percentage of what we think it's worth. The stock price is much lower relative to our fair value that we think a stock can be worth, and that's our discipline.
Yeah, and you do it well. And I may state that because people ask me so often. I don't get remunerated for saying anything good about FFND or FNF.
Not even flowers. Not even flowers.
Exactly. The flowers are for Ross because I deserve those ones. So
Ross owed you the flowers. He was too tough on you that one day.
Yeah,
that was funny. All right, let's we like to have a little bit of a fun too in the shows, Gary. So I don't know if you know this. We've been doing some of these discussions, and so you were a person who was talking a lot about the Twitter overhang. We've got the new CEO. I'm sure you're happy about that. Now we got Threads versus the Twitter. So I'd just have a nice, fun conversation here about whatever you guys want to talk about. If you want to address the Twitter CEO and what you're thinking there, and then if we can get Jeff and Alexandra's opinion on Threads.
Why don't you guys go first?
Okay, I don't mind if you don't mind, Jeff. So the first thing is I've never been a huge fan of the whole metaverse. But for my business, I get about half my clients from Facebook. It's incredible, right? But I mean, I'm obviously my day job is in immigration, so this is a very particular group, and they are extremely good on Facebook in targeting very specific groups, and with their Facebook groups and whatever. That is where my clients come from. At least half of my clients. I never paid a penny in advertising on Facebook, but I did profit enormously from the way they cluster their clients or their users. So I was always very, uncomfortable that they know so much and use so much and sell so much of the information they have about everybody else. And so I just feel this whole Threads thing is a beginner's copy of Twitter, taking all the information they already have on Instagram, where they have deep information about each and every user, and incorporate that on Threads. So will Threads be commercially successful? No doubt. Instagram is an extremely powerful marketing tool for advertisers of all sizes. And with that knowledge, Threads will become, and advertisers don't care about politically correct and freedom of speech and whatever. What advertisers care about is, do they get to their user? And that has been by far not Twitter's focus until Linda came up. And Linda's just been here now for what, a short month, 3-4 weeks. So she gets thrown quite a beef here with a competitor that has enormous data from their Instagram platform and unlimited money to throw at a new platform that doesn't have all these headaches that Twitter is. I mean, why do we see all these bots? Why do we see all this data scrapping? Why do we see all these things that don't work on Twitter? It's just because it was an outdated old platform that Elon overpaid. Now, from a morals point of view, I will always be a Twitter's girl. I love the free speech. I love the fact that there is so much conflict there. I love the fact that there is so much, raw truth there, which I suspect will never happen on Thread. Thread will be, it's a shame that Christian is not here, a bubblegum sweet version of Twitter, which will appeal a lot to the advertisers because they won't have all this conflict and they won't have all this thing, but it will not have the same appeal to people that are out there for information, for truth, for conflict, for discussions. It's just a completely different group of people.
Yeah, I signed up for it, and it's interesting. First of all, so it pulls over your Instagram followers, which I didn't have a lot. It's just a completely different kind of thing. What I find interesting is that there's this universal acceptance that it's a happier, friendly place, but nobody actually asked the question of how does it get to be a happier, friendly place? What do they do with information? What's the algorithm look like? The Twitter algorithm was open sourced in March of 2023, and if you can get onto GitHub and read it, you can understand the decisions they make and how the For You page is actually compiled for you and your account on Twitter. And I believe gestures like that are genuine and will continue to actually help the image of Twitter moving forward. Whereas on Threads, you actually don't understand it. And I know there's several groups of people that have already been on Threads and have been throttled significantly. So I'm on it. I'm looking at it. It seems to be a little bit limited at this point. You can't edit a thread once you've put it out. I think these are all features that may come, over time. But it'll be interesting to see. I was just shocked when I was watching a lot of CNBC today, and literally every hour they were mentioning the app. They were mentioning their handles on the app and that they've all joined the app. And I'm like, what's going on here? And sure enough, I looked up the advertising for Meta on NBC Universal and CNBC, and specifically for CNBC, Meta bought $100 million of ads last year. So, I think that's something that they should actually disclose when they're talking about the service. By the way, this service isn't going to run ads probably for the foreseeable future. So it's not accretive, and the TAM it's going after, let's say Twitter is $5 billion and they're going after part of that TAM, and Meta's $100 billion company. So they're going to maybe add a couple of $1 billion from doing this. Who knows where that actually goes? But I found that interesting. And then just finally on Meta, I found it interesting what's happening with the price action. So it added a lot with the start of Threads, but now it's a 37 forward PE on, I think, flat to single digit growth. So that PEG ratio is gone up, and it's going in the wrong direction. So it just maybe it's kind of reached its point of equilibrium at this, or they're going to surprise on earnings in the future. It's going to be one of the two.
Yeah, I'm going to do a quick comment on this. I think that all the conversation so far is like as if Threads is a competitor to Twitter, and it's a copy of Twitter. But actually, you got to remember, Twitter is moving fast towards becoming an x.com all-in-one app. So actually, just like you said, Jeff, Meta and Zuckerberg are in defensive. They're trying to stop what's going on. This is something that was an afterthought. They put it together. It's a minimum viable product. They need to add Twitter-like features because Twitter is adding Instagram features. They're adding shorts and TikTok features. They're adding long-form content. They're now doing long-form videos. And soon they're going to do financials. And so all of these other companies, they either stand still and focus on what they're doing or add on other features to actually be able to truly compete in the next year or two when you actually see the new landscape at that point. They will be successful because they have just everything in that they need, as Alexandra was putting in place. But I don't see it as a threat to Twitter. We should just move on and just remember for Tesla and for Twitter people that it's about X.com, not necessarily Twitter itself by itself. So as we talk about that, how does this relate to Tesla? What do you think, Gary?
Look, I think it'll be successful both in terms of getting new users. I saw today they're up to 30 million people have signed up. And remember, and I think it'll be commercially viable, so I think they will get ads. And it is a, we'll call it a more hospitable environment. And, Elon kind of put it correctly is, would you rather, pay attention to everybody's happy, and shows outward being happy, but they're miserable inside? Or can't remember, would you rather, argue with people the way, you do on Twitter, and it's pure and it's unvarnished? And I would much prefer the Twitter experience. I think Elon's done a great job of adding features to Twitter, making it, for somebody like me, who, I tend to struggle with a 240 character limit, and now I can put as many as I want. And as you say, they're adding videos, they're adding, features that, people have asked for a long time. But then on the other hand, you have this new limit where you can only view so many tweets, which again, I don't have a problem with it. That's the way social media works. It's an all you can eat type pricing plan. And if you look at Netflix, it's the same way. You look at YouTube, it's the same way. So I don't have a problem with it. But, if Instagram's Twitter doesn't have that, it's going to make Instagram's Twitter more viable. So, what I don't like about the new, whatever you want to call this thing on Instagram, Twitter is, you've got people who aren't followers on your feed. So I guess you can somehow, do something to get rid of them. It's not chronological. It just feels more like a mass of stuff, and it's not organized the way Twitter is. So, and then you throw, Linda Yaccarino into the mix. She's a media person, and one of the things I was very happy about is they didn't put a tech person into Twitter. They put somebody who understands advertisers in there, and I gotta believe that she's going to convince advertisers to come back. And this is why it's important as a Tesla shareholder to understand this. I think if the advertisers do come back and she can convince them to come back, and that Elon can just, stay neutral on the political stuff, which is asking a lot, but hopefully that will happen, then real Twitter can be cash flow positive by third quarter. And then, Elon's not going to have to be selling more Tesla shares to fund it. And that's my hope, that she turns this around where the advertisers come back. And I'm not a big fan of, them suddenly charging everybody $8, because before this all started, advertising revenue was 90% of Twitter revenues, and the other stuff was 10. It's very hard to kind of flip that around. That's what people grew up with on Twitter. So it's got to be an advertising-driven model, not a fee-driven model. And I think, I've spoken with Linda, and I've known her before she took the job. I got to know her before she took the job, and she's still really optimistic about it. She's working great with Elon, and they've got a real partnership together. So I feel optimistic that the cash flow will turn positive later this year. And then if we can get to 2024, you got the Olympics and you got the election. Those are two big high, ad revenue events that could make Twitter be really positive. And again, hopefully Elon's not going to have to sell more Tesla shares. That's my goal.
Yeah, it also showed me, and this restriction phase, I think actually is only for a short duration. It may actually be over already, but it also showed me how valuable Twitter conversations are. The simple fact that there are other companies out there that scrap what's on Twitter, which for me is the only real language, right? I mean, you can scrap Instagram, but that's all fluff. You can scrap Facebook, that's even worse fluff, right? There is nothing out there that gives me real conversations in this quantity and with this rawness. I think rawness is probably the best word. And so it is of high interest. So, and I don't believe Zuckerberg is building anything that comes to, to that level of rawness. So the interest and probably the price paid for Twitter may in the end be valuable for Truth, GPT, or whatever else X is building, because obviously it's valuable to other people. I was surprised how valuable it is to the fact that it slowed down over a long weekend the whole Twitter universe to get rid of.
That's a very good point. Wonderful. Thank you so much, Gary. Really appreciated you joining us today. That was fun. I've been curious because obviously it's been a while since you've been on the show, and we've had some big events. We had the Q2 numbers come out. So many great things happening this month. And so Q2, July 19th is the next thing to watch out for. And appreciated you so much. Thank you.
Okay, thanks. Thanks for bringing me on.
Thanks, everybody.
Thank you.
Always a pleasure. Bye-bye.